Financial Market and Institution Introduction. Before understanding about this course, we should know what is a financial system to understand what a financial markets and institutions. Financial markets and financial institutions are a component of financial system. This means the financial system consists of these financial markets and institutions as one of the components. The financial system has also other components such as financial regulations and financial assets. To understand what all of these are, we should look at them one by one. A financial institutions are institutions that are established to provide a financial service for its users. A financial assets are what these financial institutions use to deliver the service. A financial market is where the service is provided to its user. The only participants in the financial markets are not only financial institutions. There are also other parties. For example, investors. If two investors had a transaction one with another, it might be any financial transaction. The place where they make this financial transaction is called a financial market. A financial regulation is a regulatory system that regulates all of the components of the financial system. It regulates the financial institutions and financial markets, all financial activities that has been done in the financial market. As we all know, market can be classified into three types: factor market, product market, and financial market. Or you can name these two as commodity market. This means where a products and services are exchanged, but here only financial assets and financial liabilities are exchanged. For example, if bond is a financial asset for the holder, it is a financial liability for the issuer. Where this kind of activity is done is in a financial markets only. So you might wonder, if a financial market is where a financial assets are exchanged, what is a financial asset by itself? What is a real asset in the financial asset? The value of a financial asset is obtained from the agreement of peoples. That means if peoples disagree, that instrument doesn't have any value, the instrument will not have a value. That is the nature of financial asset. However, a real asset is an instrument that will have a value on its nature, whether peoples agreed on or not. For example, think of this house. This house has a value always, even peoples does not agree with all. Also think of this food. This food will give you a benefit. It has a value whether people agree or not. However, if you take this cash, this is not a real asset, unlike these two. This is a financial asset. So if all people believe that this paper doesn't have a value, it will not have. For example, if people change the currency, it will lose a value at once. So the value of this cash is only based on agreement only, based on people's agreement. That is the difference between a real asset and a financial asset. Money is not only a financial asset. There are a lot of financial assets that their value is determined based on a people's agreement. So if we say that a financial market is where these financial assets are traded, let's look at the types of financial assets. Financial markets. So before looking the classifications, guys, that I need you to know there are different ways to classify things. For example, think of these two couples. If you classify these two couples based on height, she is tall and he is short. If the factor is color, he is black and she is white. If the factor is sex, based on sex you can classify them. He is a boy and she is a girl. So just like that, we have different factors to classify things. So we have also different factors to classify this financial market. So we look at them in terms of maturity, claim, and market character. Don't worry, we'll explain them what they are. So in terms of maturity, financial markets can be classified as money market and capital market. So we have said that financial assets get their value from the agreement. So there is a time where the agreement starts or formed, and the agreement will be settled. The time where the agreement settled. So the time range between these two gaps is called a maturity. So this is the starting date that the agreement has been signed, and this is the ending, or we can call it a maturity date. The period between these two is called a maturity period. So based on this maturity, we can classify them as money in capital market. If this maturity period is short or less than 1 year, we can call the place where these marketable securities or financial instruments that has a maturity period less than 1 year are traded is called a money market. But if the instruments that are traded in these financial markets have a maturity period more than 1 year, we can call the market where they are being traded is as a capital market. So a money market is a place where financial assets that mature mostly within 1 year and they are considered to liquidate easily like money. And mostly when I say liquidate, it's been turned to cash easily. It means how it is easy to turn these instruments to cash or to sell them. That's what we call liquidity. So they are more liquid than a capital market securities. So they have shorter period. They don't have that much risk. So if the risk is low, the return should be low. That's why these instruments have a lower return than a capital market instruments. They are an instrument served to people in the country by the government. The word this treasury represents, the issuer is a government, and this bill it shows it's a short-term security, and they are the safest of all other securities. Why are they considered the other instruments? Because treasury bill is issued, hence they are issued by the government. The government doesn't have any default risk. Before that, something that you have to know is a money market instruments are always a debt instruments. There is no equity instruments in the money market. However, the capital market includes a debt market and an equity market. Why is that? Because equity doesn't have a maturity period less than 1 year, because as long as the company operates, this equity instrument will not be returned to the issuer. So as long as this instrument is not returned to the issuer, we cannot say that the maturity period has been reached. So the money market is a place that supports the exchange of a short-term securities. It doesn't include any equity instruments in it. So these treasury bills doesn't pay any interest. However, their interest is an implicit interest rate. What is implicit interest rate? Guys, if you want to know how a debit market or a debit instruments work, check this link. I have a video on that. You can clearly know how bonds and other debit instruments work. So I do not explain how a debit instrument works, but what is implicit interest rate and explicit interest rate? An implicit interest rate is where the interest is not separately stated. For example, if I say I will sell for you $100 bond, I will sell you $100 bond with $100 bond with $90 only. So today you buy with $90. So on year 1 I will not give you any interest. Also in year 2 I will not give you any interest. However, on let's assume the bond mature within 2 years. So after these 2 years I will give you $100. That means you bought with $90, but finally you received $100 at the end. The interest here is 100 minus 90, that is $10. This $10 is not explicitly stated in terms of percentage. However, you bought at a discount and got the face value at the end. This is what we call it the implicit interest rate. However, if I sell $100 bond for you, that means I receive that $100 today and will give you the bond. So after a year, I will give you, if the interest rate is still, the maturity period is 2 years, and the interest rate is, let me assume it's 10%. So 10% of 100 is 10. So at year 1, I will give you $10 as an interest payment. Finally, when the bond matures on the year 2, I will return the face value at 100. That means I receive the bond and will give you the money with 10% interest for the second year. So the bond that this interest rate is, this 10% is explicitly stated, is called an explicit interest rate. However, if the interest rate is not separately stated, it's called an implicit interest rate. So a treasury bill is where the government issues the bond, the bill at a discount, the debt instrument at a discount, and redeem finally pays you a face value where you have agreed at the start, which you have agreed at from the start. So at maturity, even the government doesn't have any money to pay off its debt. That means the government can print money. Even he can use that option to pay you back. That's why these instruments are the safest, because being a short-term instrument by itself makes them less risky, and hence the issuer is the government itself. That means the risk low. So the other money market instruments are certificates of deposit. These instruments are issued by depository financial institutions. Forget this word and think of bank, only a bank, because we will look this topic in detail. I hope it will be difficult for you to understand without knowing what a depository financial institution are. Financial institutions are classified as a depository and non-depository. Depository financial institutions are an institution that operate using individuals' money or other people's money. That money is called a deposit. However, non-depository financial institutions the same way operates using individuals' money, but that money is not a deposit. So probably you might be wondering about what one of the money is called a deposit and one is not. So to classify the money that's collected from individuals as a deposit or not, we should understand the characteristics of deposits. A deposit is where you put your money in one institution or any other party, and you will receive a periodic interest based on your agreement. So it has a return. So in some scenarios, you might agree to have no return from the start, like in a checkable deposits account. But that is also an agreement. If you agree to have a specific interest from the start, you know how much interest that banks or financial institution or that party pays you. So he can only pay you based on that agreement. That will not be up or down. Also, probably you might take your money whenever you want or put it there until the maturity period based on your agreement. However, for example, think of a pension fund. This is the funds that give you a retirement benefit when you retire from your work. So the money that you contribute to these funds is not considered as a deposit because you cannot take your money whenever you want or after waiting for some time with the agreement of this fund. But in depository financial institution, you have to, one is to take out your money whenever you want, like in demand and saving accounts or in time deposits account or fixed deposit account. You will have an agreement from the start with the bank. I will not withdraw the money until this specific date, and the money will remain with the bank for some time that you have been agreed on. So you cannot do that in pension funds. If you see mutual funds, the money that is invested in mutual funds is not considered as a depository, because before that a mutual fund is a fund that receive money from different parties, but notice that money is not considered as deposit. Remember this. So they collect the money from different persons. They will invest that money, and after getting a return on that investment, they will prorate their profit to the investors that they receive the money from by taking some amount of money for themselves as a commission. So it is difficult to name this money as a deposit. That's the money that you invest in a mutual funds, because in a bank or other depository financial institution, you will receive a periodic interest payment or a return based on pre-agreed amount. However, in a mutual funds, if the mutual funds is more profitable, it will give you more amount of money or return for your investment. However, this mutual funds incurs loss, even it might not pay you anything. So you will not have any agreement to have some amount of return from the start. And that is not the nature of a deposit. So a deposit is the money that you put in a financial institutions that pays you back agreed amount of return, and that you can withdraw the money based on the agreed specific date, or if you agree to withdraw any time, like demand and saving accounts, you can also withdraw it whenever you want. Even for example, if you see insurance companies are not a depository financial institution. The money that you invest in insurance company is not considered as a deposit. Why? Because you cannot withdraw the money easily, and the return is contingent. You might get the return if you incur some accident, or you might not get anything from that insurance company after paying all of those amount of monies for that insurance company. That's why we classify insurance companies as in a depository financial institution. So we can probably, you might think that after hearing this, all banks are a depository financial institution, but some banks are not a depository. For example, if you see investment bank, it's not a depository financial institution, it's a non-depository. Want to know what an investment bank is? For example, think of this one company. A is a company that wanted to sell its share for the public. B is a group of investors, and this is the investment bank. So probably this company might sell directly to these investors, or this company might give its shares to this investment bank, and the investment bank will sell these shares on behalf of this company for the investors, and take the money from the investors and distribute to the company again. So from that, it might take some amount of commissions. So the money that is invested from this group of investors to this investment bank is not considered as a deposit. That's why this investment bank is not a depository financial institution, because they do not have any agreement to withdraw this money from the investment bank. If you are think of yourself as one of this group of investors, you don't even have fixed amount of return like interest for your payments to this investment bank. So you cannot consider this investment bank as a depository institution. So investment banks can also earn some fees by advising some services related to mergers, acquisitions, and other corporate transactions. We don't care about these things, but they are also engaged in advisory services, and they can earn fees from that. The other non-depository financial institutions are investment banks. Probably, if you might not know this, it might be hard for you to differentiate investment banks from mutual funds. They give the same service as a mutual fund. So both investment banks and mutual funds works in this way. For example, think of these are the money from different investors, or think of these are investors. So one might have a small amount of money that's hard to invest in any company. However, this investment company pulls different resources from different investors. They will have a large amount of money to invest in different portfolios. Also, from those investors, one might have too much amount of money but doesn't have a knowledge where to invest. However, investment companies have the knowledge to invest that this person lacks. So if this person afraid to invest his money, because of thinking I do not have enough knowledge where to invest, these investment companies might help him. So after pooling different resources from different peoples, they will invest in diversified portfolios and bring the returns to the investors by taking some amount of commission for themselves. This is how both investment banks and mutual funds work, but their difference is very minor difference, and that is there are something called open-ended and closed-ended investment companies. Open-ended investment companies are mutual funds. So when these companies pool the money from different investors, they do not only take the money, they sell their shares to different investors, allowing even the small groups to buy it. So if there are mutual funds or open-ended investment companies, you cannot sell your shares in the secondary market. So for example, if these investors want to sell its shares, the share of this company, the investment company, if it's a member, cannot sell to any other person. Rather, every time he wants to sell his share, he can only sell to this investment company or to this mutual fund. So the mutual fund is continuously buying and selling its shares. So you cannot transfer it for another party. However, you can sell your share again to this investment company and take your money. However, when it comes to closed-ended investment companies, there is a predetermined fund size. Once the fund reaches its predetermined size, any investor cannot join. So for the assumption, if the company wants these 5 members only, just to make it simple, if let me think of it as a 5 shares and 1 year for 1 year investment period, this company will not, after selling these 5 shares, this company will not issue additional shares for another investor. And also, these investors cannot ask his money like the previous open-ended companies. He cannot say, give me my money and I will give your share back. He cannot. Classification is a capital market. When we have talked about a money market, but a capital market matures more than 1 year. Securities that are traded in capital market matures more than a year, or it's where securities that matures more than a year are sold. We have gone through a lot. Probably you might forget what we are talking about. It's about classifying a financial market, and I've put this picture for you to remind you we can classify financial markets based on different classification methods. We are classifying based on maturity. So capital markets, as we have said, might contain a debt or equity market. However, money market instrument only contains a debt market and a debt securities. There are something called primary and secondary market in a capital market, which are not in money markets. So what are primary and secondary markets? So a capital market might also contain a derivative instruments which are not debt or equity. We will talk them about in the future session. A primary market is this. Let me explain. Forget about these people for the time being. Let us say the company is established and wants to sell its share for the public for the first time. Consider this as a public. Probably he might sell directly to this public, or he might use an investment banks. As we have discussed, an investment banks will sell the share of this company on behalf of this company. They do not buy and sell the company's financial asset. However, they receive the financial assets of the company and sell for the public, and from the money gained from selling the security, they will take some amount of money as a commission and distribute to the company. So they sell the share of this company on behalf. They do not buy and sell it. However, they receive and sell on behalf of this company and return the money that they receive from the investors. So this is called an initial public offer. An initial public offer is when the company offers its financial instruments or equity instruments. So let me consider about equity. Let's talk about equity instruments for the time being rather than talking about debt or derivative instruments to understand the capital markets well. So for the first time, when the company serves its share or offers its share for the public for the first time, we call it initial public offer. This is on a period 1. On a period 2, or we can say it as year 2, the company wants more or needs additional capital. At this time, the company again issues some amount of shares to the public. This is called a secondary offer. Like we have discussed in previous, he can use an investment banks or directly sell the financial instrument or the equity instrument to the public. But this time you can call it a secondary offer. However, if the company repetitively sells with a seasoned amount of regular interval of time, if he sells the share to the public, or if the offer is with equal time range, for example, if he sells for the third time, for the fifth time, for the fourth time, for the sixth time, again and again with equal interval of time, we call this as a seasonal offer. So there is initial public offer, secondary and seasonal offer. In all of the offers, he can use investment banks or might sell the shares directly to the investors or to the public. The investors or the public can also exchange this company share with another investor. This is called a secondary market. A primary market is when the company directly sells or when the shares are directly sold from the company to the public. However, if the exchange happened in the public, for example, if the one investor sells the shares that bought from this company to the another investor, we call this as a secondary market. A secondary market is where this instrument is sold after initially sold by the company itself. So there is a difference between a secondary offer and a secondary market. Secondary offer is when the company serves or offers its share for the second time to the public, and the secondary market is a market where investors themselves transact with one another. Put this picture is that you cannot say always IPO is where the company sell its shares for the first time. This might be confusing, but I will explain. There is something called a private placement in the public offer. A private placement is that when the company sells its shares only for some selected peoples only rather than for the whole public. For example, when the company is established, if he sells the share for these 3 persons, selected persons, the company will select this person and sell its shares only for these persons. So this time we can say that the company has offered its shares but not to the public. So initial public offer is when the shares are primarily offered to the public. However, private placement is when the company offers the share for only for some selected individuals only, probably to start up its business, or might be for any other reason. So these times previously the company has sold these shares to these 3 selected individuals in a private placement. However, we cannot say that IPO is where the company sells its share for the first time. Probably he might sell it in the private placement rather than a public offer. However, we can say that IPO is where the company offers its share for the first time, but to the public only, to the public. rather than a private individual. So let us return to our original topics, which is classifying financial markets based on maturity. We have seen money market and capital market instruments. We have seen primary and secondary markets. So now let's look at the financial market classification based on their claim. But before that, I need you to notice this thing. This primary market and secondary market concept or idea works for debt market, for derivatives, for all financial instruments that are traded in the capital market. It's not only for equity instruments. I just want you to understand the concept. For example, a company might issue a debt instrument such as bonds, but there is no IPO here. And secondary offer in such a seasonal secondary offer such as we cannot call that for the bond. We use this term for the equity market only. So in bond you can say that primary market is always when the company sells its debt instruments to the public directly. It's not from one investor to another investor, however from the company itself to the investor or to the public. When that debt instruments offered to the public, we can call it as a primary market, or the debt instrument is being sold in the primary market, whether it is the first time, the second time, or the third time. We will not use the terms like private placement, initial public offer, or seasonal offer, secondary offer, or such type of things are for equities rather than for debt instruments. For debt instruments, when the company sells directly for its debt instruments to the public, we will say that the primary market. When the company's bond is being sold in the market from one investor to another investor, or when it is transferred from one investor to another investor, we can say that it is being sold in the secondary market. So here it is a primary market even for the third, sixth, whatever it is. Also derivative instruments might also be sold in the also even for the third, sixth, whatever it is. Also derivative instruments might also be sold in this market. But don't use the terms like seasonal IPO in such as equity related terms for derivatives also, just like the bond, because derivative instruments are neither equity instruments or debt instruments. They are different financial assets. So if we return to our original topics by classifying financial markets, we have finished based on maturity. So based on claim, a financial market can be classified as a debit market and equity market.
Represent a contingent claim, the right, but not the obligation, to buy or sell the underlying asset at a predetermined price and time. So we cannot categorize derivatives as either a fixed interest claim, debt, or a residual claim, equity.
Classifying financial markets based on maturity. Now we are classifying a financial market based on claim. One is where a debt instrument is that have a fixed interest claim. That means they can ask their return or principal amount when it is an appropriate time to ask based on the contract. That means the company cannot pay the dividend for equity shareholders without paying an interest of a debt holders. Even when the company liquidates the first claim or right on the company's assets, that means when the company is sold, the money is firstly or primarily given to the debt holder, and the residual amount is paid to the equity holders. Also, in yearly operation, if the company is not profitable, the company might not give a dividend for equity shareholders. However, it is a must to pay its periodic interest payment, so they have a primary claim. However, the equity holders has a residual claim. So based on claim, a financial markets where An instrument that holds a primary claims are sold is called a debt market, and where an instrument that holds a residual claim or a financial asset that holds a residual claims are sold is called a capital market. However,
derivative instruments. Derivatives do not represent a direct claim on the underlying, so we cannot categorize derivatives as either a fixed interest claim, debt, or a residual claim, equity. Derivatives represent a distinct type of financial claim, a contingent claim on the underlying asset.
Another way to classify a financial market is based on the market character. For example, there is an organized market and over-the-counter. He can get every information about the company, its information and its financial statement, its ratio, a financial ratio, and any other things, any information about the company, both the share of. So this is a centralized marketplace where the third party enters and makes all the informations available. It can take a larger volume compared with the over-the-counter market. Hence, everyone feels safe and make sure that he is not suffered any evasion. So instruments, financial instruments are sold and bought constantly with a higher liquidity. So in this market there is a higher liquidity. You can say that there is a higher liquidity in this market. However, over-the-counter market is where the buyer and the sellers meet without the third party that makes every information available, or without the third party. This third party is responsible for making all informations available or to create information symmetry. However, in over-the-counter market, these two parties will meet without including the third party that makes the information available. So information asymmetry is created here. That means if one has an information, the other might not. So the person who has more information might make some fraudulent activities on the person who has not. So this is where the traders meet one another themselves rather than involving the third party that is centralized. By the way, this third party is a centralized like New York Stock Exchange, which is a huge market that is centralized and makes all the information available to the buyer and to the seller for both of them. This means both of them are not susceptible to any evasion that can be created with information asymmetry. Also, based on the exchange process, it might be floor based. This means physically, the one gives the financial instrument physically and receives the money, such kinds of agreements, or it might be electronic based using a digital currency. So we have seen one of the components of financial. Just a financial system is a combination of these financial institution regulations, assets, and markets. We have seen what financial markets are classified and how do they look like. Now it's time to look at financial institutions.